Welcome back. Take a look at futures this morning. We are 6 minutes away from economic data, and we are at the highs of the morning. The Dow Industrials right now up 79, the Nasdaq up 29, S&P 500 higher by 10 points this morning as the rally goes on. The year end has been incredible. Take a look at interest rates as rates have come off of the highs of the year. We are looking at the 10-year yield now at 3.91%. That is down 2 basis points this morning. We also want to take a look at the Japanese yen after the Bank of Japan left interest rates unchanged this morning. In step with the other world central banks that have also taken a pause in the last week. Joining me right now is Piper Sandler's chief global economist of macro research, Nancy Lazar. Nancy, it's great to see you. Hope you're having a good holiday season. What is your reaction to the central bank's decision to leave rates unchanged?
Well, from a Japan point of view, I can totally understand it. Real economic activity in Japan is still struggling, and they really want that economy to have momentum as they go into 2024. So totally in sync with the BOJ continuing to support economic activity. Inflation has picked up. Wages are picking up. So they're moving in the right direction, but real activity is still struggling, and so they need to see some incremental unit growth before they start to pull back. In addition, the currency has actually appreciated a little bit. That was a problem as far as fueling potentially too much, say, bad energy inflation, higher energy prices as the currency goes down. And so that currency, more stability is also a plus that the BOJ doesn't have to really move aggressively here.
Nancy, you've been writing about credit conditions tightening and the idea that you pushed out your expectations for a recession into the next year. But I want to get your take on what's happening now and whether that's going to shift anything, because Danish shipping giant AP Moller-Maersk announced that it is redirecting 20 of its vessels to sail south of Africa to avoid the Red Sea. That is because Houthi militants and Houthi terrorists have attacked ships. Nancy, you've got Maersk right now saying that it is not worth it to actually go into the Red Sea right now. This is a major route going into the Suez Canal, and it certainly could be a major issue for supply chains and for the broad economy. Do you worry about this? What impact is this going to have on shipping and the consumer industry?
Well, first, from a supply chain perspective, I think that story is pretty much over. And that's because there's no longer pent-up demand on the part of consumer. And secondly, there's still plenty of inventories in the retail space, and you even also see it in autos. So back in 2021, you had a very, very strong pickup in consumer spending, strong demand, limited supply because of the supply chain issues we had with China at the time. So I don't think it's that big of an issue today from a consumer goods perspective. I do think it's an issue for business confidence. What you see geopolitically, obviously, around the world is a real risk to business confidence and another potential risk to companies wanting to spend here in the United States or any place else in the world. So it's not a big issue today as it was 2 years ago, but at the margin, it does hit business confidence. That's where I see the biggest risk from what's going on geopolitically today.
Business confidence, consumer confidence, all also getting impacted by these tighter credit conditions. Yeah. So far, we've seen the interest rate sensitive groups of this economy take a hit from 11 rate hikes. We're waiting on housing data. It'll be out in 2 minutes' time. We'll see what the housing starts and the building permits tell us. But how would you assess the consumer today, about a week away from Christmas?
Yeah, the consumer is actually being very cautious this holiday season. They're really focusing on where can they get the best buy. They are shopping at discount stores in particular. Foot traffic for the normal retailer is down dramatically as we moved into the first 10 days of December, which is very, very unusual. They're really, really using e-commerce. That's perhaps because that's where you have the clearest picture of what's going on with prices. And e-commerce prices are down significantly. So the consumer's okay. It looks like real consumer spending in the fourth quarter will be about 2%, but it's being lifted by first discount stores, i.e. Discount prices. And also the consumer, unfortunately, is still using some credit. So we don't think the consumer is in great shape. The spending that we are seeing is being mainly driven by, again, these discounts and the higher end consumer. And so we think it continues to be this slow dance into a recession. And as you mentioned, the interest-sensitive parts of the economy, both housing, and we're pounding the table that capital spending is also deteriorating, which Chair Powell mentioned last week, and that we think is being unnoticed. And classically, going into recession, it is those two interest-sensitive parts of the economy that go down the most. The consumer kind of just deteriorates some, but really recessions are caused by both housing and capital spending declining. And we think we're going to have a double dip in housing, and capital spending is really going to disappoint, as we see here in the fourth quarter and into the first part of 2024.
So, I mean, do lower interest rates help us all? A lot of people feel like the ECB is going to cut before the Fed, but is that what we're all waiting for to take us out of this, a cut in rates?
Well, the Federal Reserve classically and the central banks generally cut rates as the economy deteriorates, and that's very clear in Europe. The European economy, particularly Germany, is basically stagnating, if not already dipping into a recession, which is why the central bank there is going to cut rates. You cut rates going into a recession, yet you still have a recession. Why? The lagged effects of that tightening cycle. And again, here in the United States, as you keep mentioning, and it's something that we've been really passionate about, banks are aggressively tightening lending standards. And you've never had a soft landing with an aggressive Fed tightening cycle and banks tightening lending standards. And the question is, why are banks tightening lending standards? And we would argue that's because they see balance sheets. They see both consumer and corporate balance sheets, which have deteriorated. They do have a lot of debt. And that you're seeing reflected right now here in the fourth quarter, and the consumer is stretched. Businesses are cutting capital spending, and we think we're going to have this double dip in housing as we go through 2024.
Let's go through these numbers together, Nancy, because the housing starts and building permits are out. The housing starts getting a surprise pickup. The number of housing starts coming in at 1.56 million. That compares to the estimate of 1.36 million. Building permits coming in pretty much in line at 1.60 million versus the estimate of 1.465 million. So again, the November housing starts better than expected, Nancy. You've got the market pretty steady. Dow Industrials were up 70 points before the number, and it stays up 72. Your reaction to the surprise uptick in housing starts?
Well, again, data are very volatile. We don't forecast based on latest data. We tend to look at the trend, and housing affordability is still egregiously low. You had the NAHB index, a home builder index, out yesterday. It did tick up a little bit for December, but it's still, traffic is still pretty soft. So again, we're going to stick with this idea that the lagged effects of the tightening cycle, egregiously high house prices, egregiously low housing affordability, that this is mainly noise rather than real signal. We're also looking for pretty extreme weakness in the multi-unit side, where you've had a pretty aggressive overbuild in that space as you go through 2024. And so that's going to also be a pretty significant headwind to overall housing starts as we move through the year.
All right, we'll be watching all of that. Nancy, it's great to see you. Sending you best regards for a happy holiday. Merry Christmas. Thank you for being here.
Merry Christmas.